Even the greatest traders lose. The difference. They know exactly how much they're allowed to lose. This single line holds the entire philosophy of one of the greatest traders who ever lived, Jesse Livermore. His success didn't come from guessing the next big move. It came from understanding probability, mastering risk, and treating trading like a mathematical equation instead of an emotional gamble. In this video, you're not just going to hear Livermore's wisdom. You'll learn how to apply it step by step in your own trading. Because once you understand what he understood, your whole relationship with risk changes forever. Let's start with the truth few traders ever accept: you will lose trades. No matter how good your strategy is, no matter how advanced your indicators are, you will lose. The difference between the amateur and the professional is what happens after that loss. The amateur takes it personally. The professional takes it mathematically. Jesse Livermore knew that trading isn't a game of certainty. It's a game of probabilities. He realized early on that even when you're wrong half the time, you can still be wildly profitable if you understand how to manage your risk and reward. Here's the foundation of Livermore's system, and the first lesson you must master. Every trade has two outcomes, but only one thing is under your control: your loss size. You can't control whether the trade will work, but you can control how much you'll lose if it doesn't. Livermore used this control as a weapon. Before he placed a single trade, he calculated his maximum loss tolerance, his pain point, the number where he would exit no matter what. He knew this figure before he entered, and that single habit changed everything. Now let's make it practical. Suppose you're trading with a $10,000 account. Livermore would never risk more than 2% of his capital on any trade. That means your maximum loss per trade should be $100 to $200, not $1,000 and not half your account. If you lose that $100, fine, move on. If you win, your reward should be at least 3 times that risk, $300 to $600. That's a 1-to-3 risk to reward ratio, Livermore's golden standard. This simple ratio allows you to be wrong twice and still make money on the third trade. That's the power of math over emotion. This is where most traders go wrong. They focus on being right instead of being profitable. They chase setups that look good emotionally but make no mathematical sense. They risk 500 to make 100. Livermore never did that. He filtered out every low probability setup before it could even tempt him. If the numbers didn't align, he didn't touch it. His logic was simple. Why take a trade that offers more risk than reward? You're flipping a coin that's already unfair. Think of it like this. If you play a game where you lose 1 every time you're wrong but win 3,000 every time you're right, you only need to be correct 30-35% of the time to be profitable. That's the edge Livermore played with. It wasn't about winning more. It was about losing less when he lost. He made the math work for him instead of against him. Now let's connect that idea to probability and expectancy. Two of the most powerful concepts Livermore intuitively understood long before computers existed. Expectancy is the average amount you can expect to make, see, or lose per trade if you repeated the same setup 100 times, even though you lose more trades than you win. That's probability in action. That's the science Livermore practiced every single day. He didn't measure success by how often he was right. He measured it by how well his math held up over hundreds of trades. That's what you should do too. Stop asking, will this trade win? Start asking, if I take this setup 100 times, does the math make sense? That's how professionals think. Let's take this even further and talk about risk units, something every trader should track. A risk unit, or R, is the amount you're willing to lose on a single trade. If your stop loss is 100, that's 1 CRN. If your trade makes 300, that's plus 3R. Tracking your performance in R multiples removes emotional bias. Instead of thinking in dollars, you think in risk units, which keeps your decisions consistent and emotion-free. Livermore didn't call it R in his day, but he lived by it. He never let one trade risk more than his predefined unit. And here's where the education deepens. Probability only works when you have a large enough sample size. 1 or 2 trades mean nothing. 10 trades still mean very little. But take 50, 100, 200 trades under consistent rules, and your average expectancy begins to show. Livermore knew this instinctively. He said, it's never one trade that makes or breaks you. It's the series. That's why he never obsessed over a single loss. The math would even things out as long as he stayed disciplined. Now, let's discuss emotional control, because this is where probability turns into psychology. When your losses are pre-calculated and your risk is fixed, fear disappears. You no longer panic when a trade goes against you because you already know the worst-case scenario. That's how Livermore built emotional resilience. He didn't suppress fear. He replaced it with structure. His confidence came from clarity. He didn't need to hope, he had data, and data doesn't panic. You can apply the same process right now. Here's how: before every trade, define your maximum risk, exactly how much you'll lose if wrong. Set your stop loss based on logical price structure, not emotion. Ensure your target offers at least 3 times the reward of your risk. Record the ratio 1:3 in your journal. Track results in R multiples instead of dollars. Review your expectancy every 20 or 50 trades, not daily. Accept small losses as part of the equation. Do this Now watch what happens when they repeat this 100 times. Sarah's risk discipline compounds. Her smaller losses protect her capital. Her expectancy carries her through losing streaks. Alex, on the other hand, suffers emotionally when losses mount. Eventually, he starts risking more to make it back. That's when probability breaks, when emotion interferes with math. Livermore knew this cycle well. He called it the operator's greatest danger: overtrading and overconfidence. Livermore's brilliance was that he treated trading like an engineering problem. He designed rules that made emotions irrelevant. His edge wasn't luck, it was logic. And you can apply that logic today, whether you trade stocks, crypto, or Forex. Let's say you're using a trading journal or an analytics platform. Before taking a position, ask: what's my entry? Where is my stop loss? Where is my target? What's my risk to reward ratio? If your answer isn't at least 103, skip it, just like Livermore did. Because every trade you avoid that doesn't meet your criteria is a win for your capital preservation. And that's the secret educational lesson here. Risk management is not about avoiding losses, it's about making losses predictable. Once losses are predictable, they stop being scary. Once risk is measurable, confidence becomes natural. Once your edge is repeatable, results become consistent. Livermore mastered this mindset long before computers or trading algorithms existed. He did it with pen, paper, and patience. But you have an advantage. You have backtesting tools, data analytics, and AI systems to calculate expectancy automatically. You can test your edge across thousands of trades in seconds. Livermore had to live through those trades to gather data. You can learn from them instantly. So when you think about it, trading hasn't changed. Only the tools have. The psychology, the math, the discipline, they're timeless. Livermore's principles are still the foundation of every professional trading firm in the world. Here's the ultimate takeaway. You don't need to predict the market. You just need to prepare for it. Trading isn't about knowing what's next, it's about knowing what you'll do when it happens. Livermore's genius was turning uncertainty into a system, emotion into equations, chaos into probability. So, the next time you sit at your trading desk, remember this formula for survival and success: define your risk, demand a reward, discipline your mind. Because even the greatest traders lose. But the difference is, they lose on purpose, with precision, and with a plan. That's how you trade like Jesse Livermore, mathematically, not emotionally. And once you make that shift, you'll never look at risk the same way again. You see, Jesse Livermore didn't trade for excitement, he traded for survival. To him, the market wasn't a game of prediction. It was a game of proportion, the eternal balance between what you risk and what you stand to gain. And out of all the principles that kept him alive through bull markets, crashes, and chaos, one number stood like a lighthouse in the fog: the 1:3 ratio. Risk 1 to make 3 simple but sacred. That was Livermore's golden rule. It was the mathematical line between speculation and self-destruction. Most traders hear about risk-reward and brush it off as a cliché. But Livermore treated it like oxygen, invisible, but essential for survival. He understood something most traders never will: it's not how often you win that matters. It's how much you make when you do. If you risk 1 to make 3, you can be wrong twice and still end up ahead. That's not luck. That's structure. That's control. That's how he stayed in the game when others were being wiped out by ego and emotion. Livermore once said, he never played for small profits, only meaningful ones. To him, small profits were the market's bait, the sweet lure that traps the impatient. Because every small, quick win secretly conditions your brain to accept poor odds. It teaches you to chase comfort over clarity. But Livermore was after something much rarer: clarity that compounds. He refused to take a trade unless the numbers worked first. Not the feeling, not the forecast, the math. Imagine you're at a table with 3 doors. Behind one, there's a $3 reward. Behind the other 2, a 1 loss each. If you play long enough, the math favors you, because your potential upside outweighs your downside. That's what Livermore saw in every setup. He was always searching for the trades where probability bowed to preparation. If the math didn't fit, he simply walked away. Because he knew something few traders can stomach. Missing a trade is a win if the risk doesn't justify the reward. And this is where most traders break. They don't lose because they're wrong. They lose because they can't stay selective. The need to act, to do something, hijacks logic. They chase every small fluctuation, treating every candle as an opportunity. But Livermore wasn't interested in movement, he was interested in magnitude. He'd wait days, sometimes weeks, for that single setup that offered 3 times the reward of what he risked. That was the discipline. That was the patience. That was the real secret. To Livermore, trading wasn't about constant participation. It was about precise execution. Each trade had to earn its right to exist. Before entering a position, he'd mentally weigh both sides of the equation. What can I lose if I'm wrong? What can I gain if I'm right? And if that ratio didn't meet his standard, he didn't negotiate with it. He didn't rationalize. He didn't hope. He simply didn't trade. Because he understood the silent law of the market: opportunity costs less than regret. Let's break down what the 1003 ratio really means in practice. Suppose you risk 100 on a trade. That means your potential target should be at least 300. If you lose 2 trades in a row, that's 200. But on your third trade, you win 300. You're not just back to break even. You're up 100. You were right only once out of 3 times, and still profitable. That's what Livermore built his career on, the ability to survive imperfection through asymmetry. Now compare that to the average trader who risks 100 to make 100, a 1-1 ratio. If that trader loses twice, they're down 200. They'll need 2 full wins just to get back to 0. The difference. The first trader works with probability, the second fights gravity. Livermore always chose the former. But it wasn't just about the math. It was about the mindset the math created. When you know you're only taking trades with a 103 reward to risk profile, you stop needing to be right all the time. You start thinking like a portfolio manager, not a gambler. You begin to see losses as the cost of business, not a reflection of your worth. That shift in perspective is what separated Livermore from the emotional majority. He didn't take losing personally, because his numbers were designed to protect him from himself. Every time Livermore entered a trade, he already knew the worst-case scenario. He'd predefined it. That knowledge gave him freedom. The emotional paralysis that crushes so many traders, fear of being wrong, fear of losing, had no power over him. Why? Because he had already accepted the loss before he took the trade. That's what the 103 rule gave him: not just better trades, but better psychology. It transformed fear into focus. He understood that control isn't about avoiding risk. It's about managing it intelligently. The moment you assign a dollar value to your maximum loss, your mind quiets down. You no longer react to every price tick, every red candle. You're grounded in logic, not emotion. That's how Livermore traded. He didn't chase the market, he waited for it to pay him his worth. Every trade was a negotiation with probability, and he refused to take unfair terms. Livermore's life was full of extremes: fortune, fame, ruin, and redemption. But the one thing that remained constant through it all was this principle. Even when he lost millions, his framework never changed. Why? Because the 103 rule wasn't about winning streaks. It was about mathematical survival. He knew the market's only certainty: losses are inevitable. But their impact doesn't have to be. That's why he measured everything through ratios, not emotions. Let's put this in modern context. Today's trader has access to advanced software, instant analytics, and AI-driven alerts. Yet, most still fail for the same reason Livermore warned about a century ago. They risk too much for too little. They accept trades that offer 101 or even 2001 setups, convincing themselves they'll make it up with frequency. But the market doesn't reward frequency. It rewards precision. Livermore's 1-3 rule is even more critical now because volatility moves faster, liquidity changes quicker, and emotional overexposure happens instantly. When you enforce the 1-3 rule, you're doing more than managing risk, you're building scalability. Think about it: if you trade a system that wins only 40% of the time but uses a 1-7-3 ratio, you're profitable. But if you trade a system that wins 60% with a 1-1 ratio, one bad streak can erase everything. The former builds consistency through structure, the latter builds dependency on emotion. Livermore built structure. He used to journal each trade, noting whether the potential justified the position. If it didn't, he'd write, "No action, poor reward for risk." That discipline separated him from 99% of speculators. He was filtering for quality, not quantity, because he knew the market offers infinite opportunities. But your capital and mental energy are finite. You can't waste them on mediocrity. Here's something most traders overlook. Every subpar trade you take steals bandwidth from a great one that's forming. By the time the right setup appears, your attention, your capital, and your confidence are already exhausted. Livermore avoided that trap through the 1-7-3 principle. It wasn't just a rule, it was an energy filter. It kept him fresh, focused, and ready for the trades that truly mattered. And yes, sometimes that meant sitting out, sometimes that meant days without activity. But that's the paradox of mastery: doing less, but earning more. Every great trader eventually learns that trading isn't about constant motion. It's about controlled precision, and that precision begins with saying no to everything that doesn't meet your standards. The 1-in-3 rule also helps you handle the emotional cycle of losses, because when your reward is triple your risk, you understand that a single win can erase multiple losses. That knowledge keeps your confidence intact during drawdowns. You stop fearing losses, because you know the math is still in your favor. And that's the psychological armor Livermore wore every day. He didn't chase validation, he chased value. Each trade had to prove it was worth his time, energy, and capital. If you really think about it, the 1-in-3 rule is a mirror of life itself. The best opportunities in life are asymmetric. The downside is limited, the upside, exponential. The best careers, relationships, and decisions follow the same structure. That's why Livermore's wisdom transcends trading. It's not just about charts, it's about choices. Risk small, aim big. That's how progress compounds. So next time you prepare a trade, ask yourself the Livermore question: is the reward at least 3 times greater than the risk? If the answer is no, walk away. Because Livermore didn't build wealth by doing more. He built it by doing less with greater precision. That's the mindset that made him one of the greatest speculators of all time. Remember this line: he never played for small profits, only meaningful ones. That's not arrogance. That's math. He wasn't chasing luck, he was leveraging logic. And that's what you must do too. Because when your trades are built on math, not emotion, you stop fighting the market and start partnering with it. You stop reacting and start reasoning. You stop guessing and start growing. The market will always test your patience. It will always tempt you to settle for less. But Livermore's rule reminds us of something timeless. Profit doesn't come from prediction, it comes from proportion. The trader who protects the downside earns the right to see the upside. That's the true essence of risk to reward. That's Livermore's legacy. So when you sit down tomorrow, looking at your chart, waiting for your setup, remember, don't trade for excitement. Trade for structure. Don't chase every flicker of price. Wait for alignment. Because one trade that follows Livermore's 103 law is worth more than 10 that don't. And that, right there, is the line between a gambler and a professional. Between chaos and clarity. Between hope and control. Most traders think they lose money because they misread the market. They blame the chart, the news, the strategy, anything that helps them believe it wasn't their fault. But if you look closer, as Jesse Livermore did, you'll see the truth. Most traders don't lose from bad analysis, they lose from impatience. They act before the market is ready. They trade because they're bored, not because the odds align. And that one emotion, impatience, silently erodes more accounts than any crash or headline ever could. Livermore used to say, "No trade is better than a bad trade." That line alone could save a lifetime of frustration if traders truly understood it. Because in those 6 words lies the mindset of a master. He knew that survival in the market wasn't about constant activity, it was about selective participation. Trading to him was like hunting. You don't fire at every sound in the forest. You wait, you observe. You move only when the target is clear and the odds are stacked in your favor. Livermore's filtering process was ruthless. He didn't just analyze the market, he analyzed himself. Before taking any position, he'd ask, am I trading the setup, or am I trading my emotions? If the answer wasn't absolute clarity, he'd walk away. He believed that the moment you trade out of boredom or anxiety, you've already lost. Because now you're reacting, not reasoning. The market rewards those who can wait for clarity and punishes those who chase noise. He had a specific routine for filtering trades. First, he looked for clean structure, price levels where demand and supply were unmistakably visible. If the chart was messy, with random movement and overlapping candles, he ignored it. He used to say, "The market speaks, but it doesn't shout. You have to listen for silence between the moves." That meant only acting when the setup looked simple, obvious, and undeniable. If he had to argue with himself about whether it was a good trade, it wasn't. Livermore treated the market like a business, not a battlefield. He saw every trade as an investment in opportunity cost. If he committed capital to a low-quality setup, he wasn't just risking money. He was losing the ability to capitalize when the right one finally appeared. That's the part most traders overlook. Bad trades don't just take your cash, they take your focus, your patience, and your psychological energy. By the time the real move comes, you're too drained to recognize it. And that's exactly why Livermore built what he called his filter of certainty. It wasn't about perfection. It was about probability. He knew he didn't need to catch every move. He only needed to catch the right ones. He'd pass on 10 average setups if it meant saving himself for the one that truly aligned with his rules. His logic was simple in the market: action isn't progress, patience is profit. He once described how he'd sit for hours, staring at the tape, watching prices move back and forth, yet doing absolutely nothing. Not because he didn't see opportunity, but because he didn't see clarity. That was his edge: the discipline to wait for alignment between price, volume, and timing. When all three lined up, when the chart, the tape, and his conviction clicked into place, only then would he strike, and when he did, it looked effortless. But what people missed was the weeks of waiting that made that one decision so precise. There's a story from the 1920s when Livermore sat out an entire month while everyone around him was trading daily swings. Reporters called him cautious, even lazy. But when the market broke exactly as he predicted, he made more in 2 weeks than most made in a year. When asked why he hadn't traded earlier, he simply said, "Because it wasn't ready." That's the kind of patience that built empires. Not constant participation, but disciplined restraint. He believed that filtering out bad trades wasn't just about spotting red flags. It was about recognizing your own triggers. Every trader has a psychological weak spot. Maybe it's the urge to make back a loss, or the temptation to prove you're right. Livermore knew his. When he felt that emotional itch, he'd step back completely. He said, "When I feel the need to trade most, it's usually the worst time to trade." That's awareness on another level. And that awareness saved him countless times. Livermore's filter was built around 3 questions: is the setup clear? Or am I forcing it to make sense? Is the reward worth the risk? Or am I settling for less? Is my mind calm? Or am I reacting to emotion? If he couldn't answer yes to all 3, he didn't trade. That was his firewall against mediocrity, and it's a system every modern trader can use today. Most traders focus on entries and exits. Livermore focused on elimination, removing noise, clutter, and confusion until only high-quality opportunities remained. He understood something crucial: there's no penalty for not trading. The market doesn't punish silence, but it does punish recklessness. When you're not in a trade, you're free, emotionally and financially. That's why Livermore often said that being flat, in cash, was a position too. A position of power. Because cash buys clarity. It gives you the distance to see things others can't when they're trapped in their emotions. In today's world of flashing screens, instant alerts, and social media hype, this lesson is more important than ever. Traders are bombarded by noise. Every 5 minutes, there's a new setup, a must-buy signal, or FOMO moment. But Livermore would have ignored all of it. He understood that the market's best opportunities rarely scream for attention. They whisper, and only the patient can hear them. When you learn to filter out bad trades, you do more than protect your account. You protect your psychology. You stop burning emotional energy on randomness. You begin to feel in control, not because you always win, but because you always act with intention. And that feeling, of knowing you didn't let impatience dictate your behavior, is the real reward. Livermore's greatest victories weren't the millions he made. They were the thousands of trades he didn't take. That's what most people miss. His success came not from doing more, but from doing less with higher conviction. That's why his patience wasn't passive, it was active discipline. Every time he waited, he was gathering information, refining timing, and building readiness. Think about it like this: a sniper spends days in silence for one perfect shot. A trader should be no different. The patience to wait for the clean, high-reward setup is what separates professionals from gamblers. Every bad trade you filter out increases the probability that your next one will count. That's what Livermore mastered, the art of strategic inactivity. He once remarked that, "There's time to go long, time to go short, and time to go fishing." That last part, time to go fishing, was his way of saying step back, clear your mind, let the noise settle. The market will always be there tomorrow. The key is to still be there too, emotionally steady, financially alive, and mentally sharp. So the next time you feel that urge, that compulsion to act just because the screen is moving, stop. Ask yourself, is this a Livermore trade or just a reflex? Because one of the greatest lessons he left us with is this: you don't get paid for activity, you get paid for accuracy. Livermore built his fortune not by predicting every move, but by mastering the space between them. He filtered out the bad trades so the good ones could shine. And that's the foundation of consistency. Not luck, not prediction, but patience, precise, practiced, and powerful patience. Because in the end, the traders who last are the ones who learn to wait. The market doesn't reward the quickest, it rewards the calmest. And Livermore was the calm in the storm, the man who proved that sometimes, the smartest trade is the one you never take. Every trader dreams of consistency, that calm, predictable rhythm of growth where your account moves upward not by luck, but by logic. But here's the hard truth: consistency doesn't come from winning every trade. It comes from understanding the math behind every trade. Jesse Livermore knew this better than anyone. He didn't judge his performance by how often he was right. He judged it by how much his right trades were worth compared to his wrong ones. That's what he called expectancy. Expectancy isn't a buzzword. It's the invisible engine that drives every professional trader's success. It's the bridge between probability and profit, between randomness and repeatability. It's the difference between saying, "I hope this trade works," and knowing, "Even if this trade loses, my system still wins over time." Livermore built his entire philosophy around this truth. A single trade means nothing, but 100 trades reveal everything. So what is expectancy really? In its simplest form, it's the average amount you can expect to win or lose per trade, based on your strategy, not your emotions. It's a formula that strips away illusion and exposes the raw math of your edge. Livermore understood that markets are unpredictable in the short term, but highly predictable over large samples if your system has positive expectancy. Let's break it down. The formula is simple. Expectancy tie win rate tie average win a loss rate tie average loss. That's it. That's the heartbeat of every professional trading system in the world. Now let's put it into context. Suppose you win 40% of your trades. Your average win is 300 and your average loss is 100. Plug those numbers in. Expectancy is a point for 300 is 0.60 is 100. Expectancy to 120 to 60 per steer per trade. That means over time, not in one trade, not in 10, but across hundreds. You can expect to make 60 every time you place a trade. That's your mathematical edge. And once you have that, you no longer fear losses, because you understand something Livermore mastered a century ago. It's not the result that matters. It's the process. Livermore didn't obsess over being right. He obsessed over having a positive expectancy. He knew that even if he lost more than he won, the math could still make him rich. Why? Because he managed his reward to risk ratio and maintained strict discipline over his sample size. He was playing a statistical game, not an emotional one. Think of it like a casino. Every casino in the world loses money on individual hands, bets, and spins, but they make fortunes over thousands of games because their expectancy is positive. Livermore thought the same way. Every trade was a spin of the wheel, but the odds were slightly tilted in his favor. That's all he needed. Because over hundreds of trades, that small tilt becomes an unstoppable edge. He often said, "Speculation is a business of averages." What he meant was that your job as a trader isn't to win today. It's to survive long enough to let the math play out. Most traders don't fail because their strategies are bad. They fail because they quit before the probabilities could prove themselves. They let short-term variance destroy long-term vision. Livermore didn't care if he lost 5 times in a row, as long as the setup had positive expectancy. He knew that one properly aligned trade, with the right conditions, the right ratio, and the right timing, could erase multiple losses and still leave him ahead. That's the quiet confidence of a professional. He didn't chase being right, he chased being consistent. Let's use a modern analogy. Imagine flipping a weighted coin. Heads pays you 3, tails costs you 1. You know mathematically that even if you lose a few flips in a row, your edge will show over time. But most traders would quit after 2 losses, convinced the coin is broken. Livermore didn't. He kept flipping, because he trusted the math, not his mood. This is where the true power of expectancy reveals itself. It shifts your mindset from emotion to probability. When you start thinking in terms of averages, you stop obsessing over each trade. You start viewing them as data points, not defining moments. You stop saying, "I lost," and start saying, "That was part of the plan." You stop fearing the downside and start respecting it as the cost of opportunity. Livermore's trading journals were full of numbers, not narratives. He didn't write, "I felt good about this setup." He wrote reward to risk 3/1, expectancy positive, sample valid. He tracked everything. He wasn't chasing perfection, he was measuring precision. That's what kept his emotions grounded even in chaos. Because when you have data, you don't need drama. Here's the beauty of expectancy. It doesn't just tell you if your system works, it tells you how strongly it works. For instance, if your expectancy is 50 per trade, you know exactly how many trades it takes to meet your monthly or yearly goals. It transforms trading from gambling into planning. It allows you to forecast growth, measure performance, and build confidence through structures. Trader A wins 70% of the time but risks 100 to make 100s, a 1-1 ratio. Trader B wins only 40% of the time but risks 100 to make 300, a 1-3 ratio. Who's more profitable? Trader B, because Trader B's expectancy is positive, while Trader A's is break even at best. That's why Livermore said, small profits are the enemies of big ones. Because low expectancy systems give you the illusion of progress, until the inevitable loss wipes everything away. Livermore's career was a living example of how expectancy compounds confidence. Each time his trades followed his model, even the losing ones, his belief in the process grew stronger. He didn't see losses as setbacks, he saw them as proof that the system was being tested and validated. That kind of mental resilience is rare, and it only comes when your strategy has statistical backing. Let's take it deeper. Expectancy also defines position sizing. When you know your expectancy, you know how much to risk per trade. Livermore always adjusted his position size to protect his expectancy curve. If market volatility spiked, he reduced exposure to keep risk constant. If volatility dropped and signals aligned, he increased it slightly, but always within mathematical boundaries. That way, his system stayed stable through chaos. He once remarked that most traders blow up not because they lack intelligence, but because they lack patience for sample size. They treat 10 trades as proof, when in reality, 10 trades are noise. The truth reveals itself over hundreds. Livermore played for the long game. He treated every trade like a single brushstroke, meaningless alone, but part of a masterpiece when viewed in sequence. That's the mindset shift expectancy creates. It makes you play the series, not the single. Just like a professional athlete doesn't define their season by one game, a trader shouldn't define their skill by one result. Livermore measured his performance across entire market cycles, bull, bear, and everything in between. Only then could he judge whether his edge still existed. And when it didn't, he didn't force it. He paused, recalibrated, and refined. Because expectancy isn't static, it evolves with the market. He knew that yesterday's edge could become tomorrow's weakness if left unchecked. That's why he was constantly adapting, always testing. He wasn't just a trader. He was a statistician of human behavior. Expectancy also protects you from emotional overconfidence. When you know your average return per trade, you can't lie to yourself. If your expectancy is negative, meaning you lose money on average, the data will expose it. That honesty forces growth. It makes you confront flaws, refine entries, and eliminate noise. Livermore lived by that self-auditing principle. He didn't fear bad results. He feared uncalculated results. Now let's talk about what expectancy truly gives you: peace of mind. When you think in probabilities, you no longer attach your self-worth to any single trade. You stop chasing dopamine highs and fearing losses. You start focusing on execution, process, not outcome. Livermore's calm demeanor in the face of chaos wasn't luck, it was the natural byproduct of statistical thinking. He saw every trade as part of an infinite game. His job wasn't to predict the next move. It was to align with probability over and over again until the law of large numbers did its work. That's how casinos win. That's how insurance companies thrive. And that's how Livermore turned speculation into science. Think of it like planting seeds. Some won't sprout, some will. But if your soil, your strategy, is fertile, you don't panic when a few seeds fail. You keep planting. You trust the process. Because over time, the averages will reward you. That's expectancy in action. Faith in the math, not emotion in the moment. So if you want to trade like Livermore, stop asking, will this trade win? And start asking, does this setup add to my expectancy? That one question separates professionals from amateurs. Because professionals measure, amateurs react. Professionals think in decades, amateurs think in days. Livermore's genius wasn't in his timing. It was in his ability to think probabilistically when others were thinking emotionally. In the end, the goal isn't to eliminate losing trades, it's to make losing irrelevant. To build a system where losses are small, wins are larger, and expectancy remains positive no matter what. That's how Livermore survived crashes, manias, and panics, by letting probability protect him when prediction couldn't. So remember this, trading isn't about perfection, it's about mathematical endurance. Every trade is a data point. Every win and loss contributes to a larger truth. Your job is to stay consistent long enough for that truth to reveal itself. Because the secret to Livermore's success wasn't in finding certainty in chaos. It was in trusting the averages and letting math turn randomness into reward. And once you see trading through that lens, you'll never look at a single trade the same way again. Every trader wants confidence, that calm, unshakable certainty you see in professionals who can enter a trade without flinching and close it without regret. But here's the truth no one tells you: confidence doesn't come from being right. It comes from knowing what happens if you're wrong. The traders who look fearless aren't born that way. They've built systems that remove fear before it even starts, through math, not emotion. Jesse Livermore understood this decades ago. While most traders tried to fight their emotions, he designed a method that made emotion irrelevant. His golden rule was simple: before you enter a trade, you must know exactly how much you're willing to lose. Nothing more, nothing less. A speculator must always know how much he can lose before he starts, he said. That single line contains the entire psychology of confidence. Think about that for a moment. Most traders chase the feeling of being right. They believe confidence means predicting the next move. But that's the fastest path to burnout. Livermore flipped the formula. His confidence came from clarity, from turning risk into a number, not a feeling. He didn't trust intuition, he trusted math. Because math doesn't panic. Math doesn't change its mind mid-trade. Math stays consistent, even when you don't. That's the foundation of psychological control. Let's make it practical. Imagine you're trading a $10,000 account. You've decided to risk 1% per trade, a 100. That means before you click buy, you already know your maximum possible loss. That number acts like a shield. If the trade fails, you lose 100. That's expected. That's part of the plan. But if the trade wins and follows a 1,003 risk to reward ratio, you gain 300. One winner can cover 3 small losses. Suddenly, trading isn't about emotion. It's about math. Your confidence doesn't depend on the outcome of one trade, it depends on following a rule that statistically keeps you alive. Now, compare that to how most traders operate. They enter trades without knowing their risk. They decide in the moment based on how they feel. If they're excited, they risk more. If they're scared, they cut profits early. This inconsistency destroys their psychology. Why? Because the brain hates uncertainty. When you don't define your loss, your mind stays in constant defense mode. Every tick against you feels like danger. You overreact, overtrade, and eventually, you self-destruct. Livermore solved that problem decades before psychology even explained it. By predefining his loss, he shut off the fear response. He didn't wait for the market to teach him humility. He built humility into his plan. And that's what modern traders must understand. You can't remove emotion by force, you can only neutralize it with structure. The structure is your position size, your stop loss, your reward target, all decided before the trade begins. Confidence isn't emotional strength, it's emotional clarity. When you define your risk, you make peace with the worst case scenario. You're no longer trying to avoid losing, you've already accepted it. That mental shift is everything. Because once you stop fighting loss, your brain becomes free to focus on execution. The fear of being wrong vanishes. You no longer ask, what if I lose? Instead, you ask, am I following my process? That's professional thinking. Livermore once said, it was never my thinking that made big money for me, it was always my sitting. What he meant was patience. But hidden in that patience was confidence. He could sit through volatility because he had done the math. He knew his boundaries. Confidence, then, isn't about control over the market. It's control over yourself, control that comes from predefined certainty. Let's analyze the psychological loop. The emotional trader feels anxious because every trade feels like a personal test. Winning makes him feel smart, losing makes him feel foolish. So his confidence rises and falls with every result. But the mathematical trader feels nothing, because his success isn't measured by one outcome. It's measured by how faithfully he executes his plan across hundreds of trades. That's why Livermore said, no man can always be right, but he can always be prepared. When you're prepared, confidence is no longer a feeling, it's a habit. To make this even more practical, let's apply a simple framework, what modern trading psychologists call the 3 pillars of confidence. 1. Numerical confidence, knowing your exact risk per trade, for example, 1% of capital. 2. Procedural confidence, trusting your process, your entry, stop loss and exit plan. 3. Statistical confidence, trusting your edge over a series of trades, not a single one. When all 3 align, emotion disappears naturally. You don't need to control yourself. Your system controls the chaos for you. Let's dig deeper into the math. Suppose you take 100 trades, you risk 100 on each, aiming for 300 profit on winners. Even with only a 40% win rate, you'd still end up profitable. 40 winning trades tie 312,000 profit. 60 losing trades told 100 a 6,000 loss. Net gain 6,000. That's the magic of mathematical confidence. You don't have to win most of the time, you just have to lose small and win big. When traders realize this, they stop chasing perfection. They start chasing consistency. Livermore knew this decades ago. He wasn't trying to be right, he was trying to be rich. He said, it was never about being right all the time, but about making more when I was right than I lost when I was wrong. That's why defining risk creates peace. Every trade becomes just one data point in a long series of probabilities. You no longer need emotional validation from each outcome. You're playing a long-term mathematical game, not an emotional roller coaster. Here's a simple mental trick that Livermore lived by: treat every trade like a business expense. Just as a shopkeeper pays rent or electricity, your losing trades are the cost of doing business. You wouldn't panic about paying rent, you've budgeted for it. Same with trading. When your risk per trade is predefined, your loss becomes a line item, not a crisis. That's why confident traders don't flinch, they've budgeted for failure. This shift from emotion to math is what builds longevity. You can't stay calm by hoping you'll handle losses better next time. You stay calm by planning for them before they happen. That's Livermore's genius. He didn't suppress emotion, he bypassed it. He made sure there was nothing left to fear because he'd already calculated the worst possible scenario. Modern traders have even more tools to apply this logic: stop-loss orders, position calculators, journaling software, backtesting tools. All of these exist to replace emotion with data. Yet most traders still rely on intuition. They ignore the math and wonder why confidence never comes. The truth is, you can't feel secure in a world of infinite variables unless you build boundaries. Defining your risk is that boundary. Let's consider what happens when you don't. You enter a trade without a plan. The market moves against you. You hesitate. Should you exit? Should you hold? You move your stop just a little lower. The loss grows. Suddenly your account is down 5%, then 10%. Now fear takes over. You exit in panic. The next day, the market reverses and goes your way. But you're already out. That's emotional trading in one paragraph. Chaos without control. Now look at Livermore's process. He defined his loss before entry. If price hit that point, he exited. No discussion, no hesitation. He didn't argue with the market. He didn't take it personally. That's why his losses were survivable and his wins were scalable. Confidence is not pretending you'll never lose. It's knowing your loss won't destroy you. Mathematical thinking also frees you from ego. The emotional trader needs to be right. The mathematical trader only needs to follow rules. The first type of confidence breaks when the market disagrees. The second type only strengthens with repetition. And here's the irony: the traders who detach from ego end up performing better because their mind is clearer. They don't see losses as failure. They see them as feedback. Livermore's approach can be summarized as control the controllable. You can't control the market's movement. You can't control when volatility appears. But you can control how much you risk, how you react, and how consistent your behavior stays. That's where confidence lives, not in prediction, but in preparation. So, how do you apply this today? Start every trade with one question. If I lose this trade, will it hurt my account or just my ego? If the answer is, "It will hurt my account," your position size is too big. Reduce it. Your goal isn't to feel brave, it's to stay alive. Confidence is built one small controlled risk at a time. And remember this: the market rewards emotional neutrality. The less you care about being right, the clearer you think. The clearer you think, the better your decisions. The better your decisions, the stronger your confidence becomes. It's a loop that builds itself, but only if you remove emotion at the source. Jesse Livermore wasn't just trading stocks. He was trading probabilities. He turned chaos into structure by giving every trade a mathematical boundary. That's why he could operate with composure even when markets crashed. His mind wasn't clouded by hope or fear. His risk was already accounted for. That's true mastery, and it's available to anyone who learns to think like him. So, if you want to build real trading confidence, stop trying to control your emotions. Control your math. Define your loss before entry. Accept it fully. Once you do, the market loses its power to scare you, because now, the worst-case scenario is no longer a mystery. It's just a number you already agreed to face. And that's when trading transforms. You stop reacting. You start executing. You stop fearing losses. You start managing them. You stop guessing what the market will do. You start knowing what you will do, no matter what the market does. Confidence isn't born from winning streaks. It's born from the structure that keeps you calm during losing ones. That's the lesson Livermore left us. When you replace emotion with numbers, chaos becomes order, fear becomes focus, and trading becomes a professional craft instead of a psychological war. Because in the end, trading confidence is not about believing you'll win, it's about knowing you'll survive. And when survival is certain, success becomes inevitable. In today's digital trading world, technology gives us advantages Jesse Livermore could never have imagined. He worked with ticker tapes, handwritten notes, and intuition sharpened through experience. Yet despite all the progress, live data feeds, algorithmic systems, advanced charting software, and AI-based analytics, Most traders still fail for the same reason they did a century ago. They don't manage risk correctly. The lesson is clear. Livermore mastered the mental side of trading with pen and paper. You, with all the tools of the modern era, have no excuse. His principles are timeless, and today's technology allows you to apply them with precision, speed, and consistency that Livermore himself would have envied. Modern traders must understand that Livermore's philosophy wasn't about the market. It was about the method. He believed success came from building systems that remove emotion and quantify risk. Let's translate that into the modern age. Before you even open a chart, you should have software or a spreadsheet that automatically calculates your position size based on account equity, stop-loss distance, and risk percentage. For example, if your rule is to risk 1% per trade, your position size must always adjust automatically. You can set this up using tools like MetaTrader, TradingView scripts, or risk management calculators online. The math is simple. If you have a 10,000 account and a 1% risk limit, you can only lose 100 on any single trade. If your stop loss is 50 pips away, your position size must reflect that. With one click, you know exactly how much you're risking and what your potential reward should be if your target is 3 times greater, or 300 for a 103 ratio. Livermore did these calculations manually. You can automate them. That's the power of modern trading. But numbers alone don't create discipline. You must also measure what those numbers produce. This is where trade journaling comes in, something Livermore did instinctively by writing down every position, price, and reason for entry. Today, you can use digital journaling platforms like TraderSync, Edgework, or Excel dashboards to track your performance. Each trade entry should record the setup, risk amount, reward target, and actual outcome. Over time, this builds a data-driven profile of your trading behavior. You'll begin to see which setups consistently meet the 1-3 risk to reward rule and which ones don't. This kind of visibility is what Livermore wished for. He relied on memory. You can rely on data. Tracking expectancy, the average return per trade over time, is one of the most powerful habits you can build. It removes guesswork and exposes truth. Suppose your journal shows that over 50 trades, your average gain per trade is plus 50, even after accounting for losses. That's your expectancy. If you continue trading with that edge and risk 100 per trade, your long-term outcome becomes statistically predictable. That predictability is confidence built through math. Livermore didn't call it expectancy, but he practiced it by reviewing patterns and only taking trades that showed consistent profitability. The lesson here is that modern traders can quantify what Livermore observed intuitively. Now let's talk about automation and analysis. Livermore sat for hours reading ticker tapes, waiting for patterns to align. Today, algorithms can scan hundreds of symbols in seconds, highlighting setups that meet your exact criteria: clean chart structure, favorable risk to reward, proper volume. You can build watch lists that automatically calculate ratios before you even look at the chart. AI tools can even rank setups based on historical performance and probability of success. That's not cheating. It's evolution. Livermore used the best tools of his time. You should do the same. The point isn't to trade more. It's to trade smarter, and that's where most traders fail. The abundance of information creates noise. They take low-reward trades just to stay active. But Livermore's patience was his edge. He filtered out 90% of potential trades because they didn't meet his strict reward to risk standard. You must do the same, and technology can help you. Use alerts instead of constantly scanning charts. Set filters that only show trades with at least 103 potential. Program your journaling app to highlight setups that don't meet your ratio, so you're aware of emotional decisions creeping in. This kind of automation acts as your accountability partner, a digital version of Livermore's discipline. Let's also talk about burnout. Modern traders often confuse activity with progress. They sit in front of multiple screens, clicking all day, thinking they're being productive. Livermore would have laughed at this. He understood that doing nothing was sometimes the most profitable move. The market pays for patience, not participation. Overtrading comes from emotional insecurity, the feeling that you need to always be in a position to make money. But technology, when used correctly, can break that addiction. You can program alerts to notify you only when your ideal setup appears, freeing you from compulsive screen watching. You can even use journaling metrics to track emotional trades, entries made outside of your plan, and analyze how much those cost you. The data will tell you what Livermore already knew. Waiting for the right setup is far more profitable than forcing trades. Livermore was doing all of this by hand, reviewing notes, watching behavior, refining his strategy. You, on the other hand, have the power of analytics, AI, and instant feedback. Risk management software can simulate hundreds of trades in seconds, showing how different risk levels affect your long-term equity curve. Journaling platforms can calculate expectancy automatically. Portfolio tools can track your average risk-reward ratio across time and display trends visually. If Livermore could see your tools today, he'd shake his head and say, "You have everything I ever needed. Why are you still guessing?" There's another reason to bring his methods into the modern world: accountability. Livermore's discipline was self-imposed because he worked alone. Today, you can use technology to make accountability automatic. Create dashboards that alert you if you risk more than your limit. Use algorithmic systems to execute stop losses without hesitation. Connect your broker to trade analytics that grade every position by adherence to rules. This is the 21st century version of Livermore's notebook, precise, emotion-free, and brutally honest. But remember, tools don't replace discipline, they enhance it. A trader without structure will misuse even the best technology. The key is mindset, the understanding that confidence comes from structure, and structure comes from consistent data. Livermore didn't have AI, but he had awareness. He knew his numbers. He reviewed his performance. He filtered ruthlessly. That's the real modern edge. Not faster software, but smarter use of it. So here's your challenge: take Livermore's century-old wisdom and apply it with modern precision. Use calculators to define risk. Use automation to filter opportunities. Use journaling to measure expectancy. Use data to refine your behavior. Every tool you need to become disciplined already exists. Your job is to use it. Livermore managed risk by hand and became a legend. You have technology that can do it in seconds. No excuses. Because in the end, technology doesn't make you a better trader. Discipline does. But technology gives you no reason not to be disciplined. Livermore made his fortune through patience, structure, and math. You can do the same, only faster. The tools changed, but the truth never did. Trading success still belongs to those who manage risk, define reward, and trust probability over emotion. Livermore did it by hand. You have AI and analytics. No excuses. If you've made it this far, you now understand why Jesse Livermore's philosophy still stands unshaken in a world driven by algorithms, charts, and data feeds. His genius wasn't in predicting the market, it was in protecting himself from it. Livermore didn't trade for excitement. He traded for survival. He knew that in the long run, survival is success. Every part of his method was built around one simple truth: trading is not about being right, it's about managing what happens when you're wrong. The traders who last are not the ones with the most wins. They're the ones who lose smarter. Let's recap the key principles you've learned. Livermore didn't chase every price move. He waited for those rare, high-quality setups where the potential gain was at least 3 times greater than the potential loss. That's what we call asymmetric payoff. If you risk 100 to make 300, you don't need to win most of your trades to come out ahead. Even if you win only 40% of the time, you still profit over the long term. That's the math of professional trading. Livermore mastered it before the word risk-reward ratio even existed. In Livermore's day, this meant writing everything by hand. Every trade, every reason, every result. Today, you have tools that make this effortless. But few traders actually do it. Why? Because journaling exposes truth. It shows you whether you're following your plan or trading from emotion. Livermore believed a trader's greatest weapon was self-awareness. You can't improve what you don't measure, so track your trades. Record your risk-reward. Review your setups weekly. The goal isn't perfection, it's progress through awareness. Most traders react to losses emotionally. They shrink positions after getting hurt or go all in after a win. Livermore did the opposite. His risk was always predefined, not reactive. He knew exactly how much he could lose before he entered a trade. As he said, a speculator must always know how much he can lose before he starts. That one sentence separates professionals from amateurs. When your risk is predefined, your emotions have no room to dictate your actions. You stop fearing losses because you've already accepted them logically. That's where confidence is born, not from winning streaks, but from knowing your downside is controlled. Livermore's real strength wasn't luck, timing, or secret information. It was clarity. He knew his method, trusted his math, and repeated his process. That's consistency. Most traders burn out because they're chasing the feeling of control instead of building control through a repeatable system. When you follow a process with predefined rules, your confidence no longer depends on the market, it depends on you. So what's the final lesson? It's simple, but profound. Don't aim to win every trade. Aim to trade well. Don't aim to avoid losses. Aim to make them smaller and smarter. Because every great trader, from Livermore to the present day, built their fortune not by avoiding pain, but by learning to control it. The market will always test you. It will always tempt you to break your rules, chase quick wins, or double down on emotion. But if you stay true to Livermore's principle, lose smarter, win bigger, you'll discover the real edge that separates those who last from those who vanish. In the end, remember this: Livermore's secret wasn't about winning more trades. It was about losing smarter. Because in trading, survival is success.